Hey, good day, everyone. My name is Bert Salazar, and I'm going to be your host for this final webinar of the year today. As you know, on a monthly basis, we do private client group webcast in which we provide information, education to all of you that are always with us and always listening and gathering data in order for you to create a much better life for you, your families, and obviously your business. Now, because we're at the end of the year, obviously we're in the middle of the holiday season. So on behalf of our firm and my family and myself, I want to wish you all a wonderful Christmas season, a wonderful holiday season. Happy Hanukkah for many of my clients that just celebrated Hanukkah a few days ago. So we're excited. We're excited about 2019. We're also reserved in many different ways because there are so many things going on in our country today and throughout the world that I think is imperative, and it is critically important for all of us to keep an eye on the ball, to make certain that you always know, where the ball is, whether it's a financial ball, a tax ball, whatever it may be, and where it is at all times in order for us to take advantage of the opportunities that may come along those lines. By the same token, as you know, 2018 was the first year of the Tax Cuts and Jobs Act that was signed by President Trump in late 2017. So 2018 was the first year. And sadly enough, many Americans have not done any tax planning whatsoever. So as of December 31st of 2018, we only have 7 years left in this new reduced tax bracket that we find ourselves in today in order to maximize our tax-free income for many, many years to come, and most important, in retirement. So today's webcast is going to be a short webcast. We're going to be discussing the pros and cons of the taxable bucket. As you all know, I spend a lot of time educating many of my clients and obviously many listeners along those lines in how it is that the IRS taxes every single product, every single service that you acquire in the United States if you happen to be a resident of the United States or an American citizen. So obviously today we're going to be specializing in discussing the taxable bucket. So we're going to do a deep dive into the taxable bucket. And the reason why I spend so much time in educating all of you in the three bucket system that the IRS uses, which is a taxable bucket, the tax deferred bucket, and the tax-free bucket, is that depending on how it is that you manage those individual buckets, it will dictate success or failure in retirement many, many times. So obviously something that I care for very much because if I'm able to save you and your family and many a times your business thousands of dollars on an annual basis, without any of you having to take any additional risk in order to get from point A to point B, then I have done my job and I have done my due diligence as a tax practitioner and retirement strategist in order to help you and your family mitigate all of the booby traps that we're going to be seeing at some point in time in the future. Now, obviously, we're going to be discussing the taxable bucket, and what I want to do is I wrote some notes here that are very important. And the first thing that I want to do with the taxable bucket is give you an overall of the good, the bad, and the ugly. Okay, but I'll start just giving you an overall of the three taxable buckets, which will make it a lot easier for you to understand as you move forward. Now, the taxable buckets are three of them, and you have the taxable bucket, you have the tax deferred bucket, and you have the tax-free bucket. Now, interesting enough, the taxable bucket, the money that you put in has already paid tax, so it's after-tax contributions. The money grows every single year, and at the end of the year, if you make money, then you're going to be receiving a 1099, which is a I love you letter, basically stating that you have to report that additional income for tax purposes in the year in which you received a 1099. And then many a times when you sell that investment that you have, you're going to have to pay either short-term or long-term capital gains along those lines. So from a taxable perspective, you're being taxed at the very beginning, you're being taxed every single year, and then you're being taxed at the very, very end. Now, what are some of the products that fit into the taxable bucket? Primarily, these are your traditional investments like traditional mutual funds, CDs, money market accounts, savings accounts that you may have at a banking institution or a credit union. All of those investments, all of those savings vehicles will generate a 1099 for you and your family every single year moving forward. Now, so I guess from a taxable perspective, the taxable bucket is not a very good bucket to have. On the other hand, there are efficiencies and inefficiencies to the taxable bucket. Now, one of the efficiencies of the taxable bucket is that this bucket is very, very liquid. So obviously, the bucket is primarily designed for you to have readily accessible funds on an ongoing basis that you can dip into at any point in time for any reason. Now, obviously, we always like to provide you with ideas and goals and objectives for the taxable bucket, because it is very critically important to understand as well that the vast majority of Americans, and many a times the vast majority of clients that we engage for the very first time, are actually paying more taxes than they need to. And the reason for that is that they don't understand how the taxable buckets work. They don't understand the difference between the taxable bucket, the tax deferred bucket, and the tax-free bucket. So they actually have assets all over the place, and many a times they have way too many assets in the taxable bucket. Now, the next question is, well, Bert, if everything in the taxable bucket is being taxed, and the products that you mentioned are products that many of us need to have in order to make certain that we have liquidity from an investment standpoint, then the next question is, well, then how much money should we keep in these buckets? And that is a very critical question, because obviously the more money you keep in the taxable bucket, the more susceptibility you and your family are going to have when it comes to filing your income taxes for the year, and the fact that you're going to have to pay more in taxes that in other scenarios you may not have to. So here's a rule of thumb I like to use with a lot of my clients. Traditionally, if you're married filing jointly, so you have a husband and wife, they're both working, they're both earning income, they have been working for a number of years, I normally recommend no more than 3 months of fixed and/or variable expenses. Now, depending how conservative you are in your finances, some of my clients just want to have their fixed expenses, their mortgages, their car payments, a certain amount of money for food and energy and so forth. Other clients are a little bit more conservative, so they want to put a little bit more. Not only do they want fixed expenses, but they also want to buffer a little bit of additional funds for things like variable expenses and so forth. Now in that scenario, because we have two employable members of the family and people that are individuals, husband and wives, that are earning income, or many a times partners, many a times domestic partners and so forth, it is suitable to have no more than 3 months of fixed and or variable expenses in those types of accounts inside the taxable bucket. Why? Because let's say one of the individuals loses his or her job, then obviously you have 3 months, a 3-month buffering in which to be able to either find a new job or many a times, start a new business if he or she would like to do so. Now, if you're married filing jointly and only one of you is working, then it would be apropos to make certain that you keep, instead of 3 months of fixed and variable expenses, that you keep 6 months of fixed and variable expenses. Obviously, the reason being that if the breadwinner, whether it's he or she loses his or her job, then obviously you have a larger and a longer buffer in which to be able to mitigate those issues and circumstances for the short term, whether it is finding a new job, educating yourself on a new skill, and or starting your own business along those lines. Now, there are times where some of my clients, instead of having 3 months or 6 months, they may have a year. For instance, we're at the end of 2018. So if one of my clients comes to me and says, Bert, we're thinking about picking up a piece of property in the next 12 months or so, and we would like to have, readily available funds in order to do so, would you recommend that we keep that additional buffer in the taxable bucket? And the answer would be yes. But again, it would be for the short term. It would be for just the either 2018 or the 2019 taxable year from a business perspective, which is something that would be very, very important for all of you to keep in mind. Now, obviously, as you know, the tax deferred bucket is the one where the money goes in pre-tax, the money grows tax deferred, and when you pull the money out, you pull it all tax free. Now, we're not going to be talking about a tax deferred bucket. We'll be talking about the tax deferred bucket next month in January, when we start again the 2019 private client group educational program and financial literacy program that we do on an ongoing basis. So we'll discuss that one in length, and then the month after that we'll get into the tax-free bucket from a business perspective. Now, what is very interesting to note by the same token is that from a business and from a taxable perspective, it is very important that you limit the amount of contributions that you place inside your taxable bucket and also inside your tax deferred bucket. And the reason being is that in the taxable bucket, you're going to be paying the taxes on an annual basis. On the tax deferred bucket, yes, you're deferring the tax. But by the same token, when you defer the tax, you're also deferring the tax liability to some point in time in the future, which we all feel that taxes are going to be much, much greater in the future than they are today. And there are many, many reasons for that. For instance, if you take a look at the national debt today, it is fast approaching 22 trillion. If you take a look at the revenues that we're generating from a governmental standpoint, we're generating anywhere between 3.3 and 3.5 trillion dollars in revenues every year, but we're paid out north of 4.4 trillion dollars every single year. So for 2018, we have a deficit. We have a budget deficit of close to $900 billion. And for 2019, and this will be the first time in history, the difference between the budget revenues and the budget expenses for the US will exceed $1 trillion. Now we're starting to get into a very scary situation, and there's a high probability that those numbers will continue to go up over the next 10, 15, 20 years, unless Congress and the government decide to do something in order to mitigate, those circumstances for the long term. The other thing that is going to be very scary for all of us is that when you take a look at the unfunded liability, and by the way, unfunded liabilities, and these are liabilities that most Americans don't know much about, because Congress makes it a very good job of not talking about the unfunded liabilities, and these are the liabilities, and these are the promises that the U.S. government has made to all of us, which they don't have the money to keep. So when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt, those unfunded liabilities actually exceed $115 trillion. Yes, you heard me right, $115 trillion. So when you have the national debt at $22 trillion and counting, when you have the unfunded liabilities at $115 trillion, and again, counting in more and more every single second of every single day, when you also have a deficit in the revenues that we're generating and then what we're paying out, there's a very, very high probability, if not certainty, that taxes are going to be a lot higher in the future than they are today. Now, I don't know if you guys have heard of someone by the name of David Walker. David Walker was the Comptroller General of the United States from actually for 10 years, and he quit. He actually resigned in 2008. And when he resigned in 2008, he went around Congress and visited with just about every single senator and every single Congress person, and also gave an open platform in front of Congress in which he talked about taxes. And basically what he said, that unless the Congress of the United States and this country, unless they double taxes in the near future, this country was going to go bankrupt. Now, you're talking about David Walker. You're talking about someone that is very bright, someone who's a CPA, an economist, someone that was a Comptroller General of the United States, and he was the head of the General Accountability Office, the GAO, which are primarily the CPAs for the US government. And he was saying that unless something happened drastically, taxes were going to have to double, otherwise our country was going to go bankrupt. And he said that there was a 4-letter word that he would use in order to mitigate his argument for the fact that taxes are going to be a lot higher in the future. And the simple word was math. And when you do the calculations and when you do the math, there's no way that taxes are going to be any lower in the future than they are today. Now, obviously, you'll say, well, Bert, but President Trump just signed into law the Tax Cuts and Jobs Act of 2017 that took effect January 1 of 2018. Again, all of these tax benefits, and this is why I encourage each and every one of you to make certain that you maximize the tax benefits that the government is giving you today. They're all going to be sunsetting. In other words, they're all going to be ending on December 31st of 2025. So we know exactly the day that taxes are going to be higher in the future, and that will be January 1st of 2026. So as of December 31st of this year, you only have a 7-year window in order to maximize your tax planning for the future. Now, what's even a bigger problem than January 1 of 2026 will be January 1st of 2028 and or January 1st of 2030. It's not that long from now. It's not that many years from now. And that's when Medicare and Social Security are going to be hitting a major, major wall while traveling at 1,000 miles per hour. That's where the big issue is going to be happening for all of us that are thinking about retiring in the next few years and thinking about living a best possible retirement that you can possibly have from a business perspective. So again, all of these things and how do you manage the taxable bucket and the tax deferred bucket will be very, very important for all of you to prepare for in the very near future, because you know, when you postpone the tax, as I said a few minutes ago, you're also postponing the tax liability. And when you do so, you may very well be paying your taxes at a much, much greater percentage than you would today. The other thing to consider, and the final thing to consider, is that at that point in time where all of us and all of you are going to be retiring, most of the deductions and the expenses that you were able to take while you were employed, they're pretty much gone now. The reason being, you know, your mortgage interest, for most of us, either your property is going to be paid for or the vast majority of the property is already paid for. So the most amount of your mortgage payments are going toward principal and not interest. So now you can no longer take that deduction, that mortgage deduction that you had been taking for many, many years. And if you do so, it's probably going to be at a much lower level than before. The other thing is that you're no longer going to be contributing to your qualified plans, whether it's your 401k, your 403bs, your IRAs, etc. So you're not going to be able to take those deductions. The other thing that will be critical is that if you're someone that likes to make charitable contributions to the charity of your choice, you're more than likely not going to be making those contributions, or you're going to be reducing those contributions because you are no longer employed, you are now retired. So you may be devoting more of your time to those charities than giving them money. And by the way, the IRS doesn't think much about your time because they don't allow you to take a tax deduction for your time. So again, make certain that you do proper tax planning, that you maximize your tax benefits for this year, for the remainder of 2018, and then for the next 7 years, because number one, your standard deduction went up under the new tax law. So if you're married filing jointly, your standard deduction is at least $24,000, unless you happen to be 65 years of age or more, so you can take an additional deduction for that. But it's at $24,000. Also, the tax brackets have actually lowered themselves, you know, under the new tax law. So you're going to see that when you file your taxes in 2018, if you had the same expenses in 2017 and also the same income for 2017, and you mirror that in 2018, you will find yourself at a lower tax rate and a lower tax bracket and with more money in your pocket than you have had in the last 20 years. So it's very important that you do your due diligence. The other thing is that the vast majority of clients, and I would argue that the vast majority of you on this call today have never truly done tax planning unless you have either engaged a tax planner or retirement strategist or someone like me and my firm that specializes in that, because the vast majority of Americans, all they do is tax preparation. And there's a major, major difference between tax preparation and tax planning. Tax preparation basically is looking into the rearview mirror. Tax planning is not only looking into the rearview mirror and doing your tax preparation for that given year, but it's also looking forward by doing tax forward planning to make certain that they can prepare you to reduce your tax liability on an annual basis as much as you possibly can, and do so legally for many, many years to come. Obviously, we're getting to the very end of this webcast, and what I'd like to share with you is that if you're interested in doing a customized tax-preferred retirement blueprint, please please feel free to reach out to me. We can schedule a 30-minute conference call, video conference. We can either visit in person, although nowadays a vast majority of my clients love the idea of doing video conferences from the comfort of their homes or offices or whatever it may be, because it's more suitable for them. But we'll be able to do it in any way, shape, or form. At the end of the day, there's no cost or obligation. You can ask me any questions that you have, either for 2018 or beyond, depending on any tax liability. And if you feel that we can move forward, then at that point in time, we will create an engagement and move forward into creating a customized tax-preferred retirement blueprint that takes into consideration your tax preparation for the year, your tax planning, looking 5 years down the line, your retirement distribution planning, and reporting, your Social Security reporting, to determine what would be the best time not only for you to pull the trigger on Social Security benefits, but for you to be able to avoid paying taxes on your Social Security benefits as well. And then last but not least, we do a Fatal 4 report for you, in which we address the 4 major issues and concerns that are going to be critical to all of you, not only now, but in the future. What is the risk to your family and your business of a premature death? What is the risk, again, to your family and your business of living too long, or living with a disability, or living with eroding factors like higher taxes, higher inflation, stock market volatility, as we have seen lately, interest rate volatility, and so forth. So when we do a customized tax-preferred retirement blueprint for all of you, it will be the type of customized tax-preferred retirement blueprint that when you do it once, you're going to want to do it every single year for the rest of your life. If you want to engage me, please feel free to reach out to me at area code 786-766-1042, or you can send me an email at Bert, that's B-E-R-T, at gablestaxgroup.com, and I will be more than happy to schedule a video conference call or a conference call with you. And one final thought, as we do in every single podcast, every single webinar that we do, every single seminar that we do for financial literacy throughout the South Florida community, I want to leave you with a thought that my goal and that of my firm is to help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change, and they change for the long term. So again, happy holidays, Merry Christmas to all of you, and we'll talk again in January, and we're looking forward to a great 2019 and for many, many more years to come. Health to all of you. Thank you, and have a great day.